So Larry Summers, Harvard professor, former Treasury Secretary, one of the greatest economists of our generation, just came out swinging, literally saying that the Federal Reserve has lost its way. You have to hear all about it, everything, because he's putting out some really interesting arguments I don't want you to miss. Check it out.
I was not hugely surprised by the numbers. In an economy that's growing faster than potential, with an unemployment rate that has a 3 handle, in the presence of massive and growing budget deficits and epically easy financial conditions, the idea that inflation would remain robust or even accelerate should not be a surprise to anyone.
This whole segment can be summarized in about 20 seconds. Money printing is bad. Money printing causes high inflation. Simple as that. It's not me saying that. In fact, it's not even Larry Summers saying it. He's just repeating what Milton Friedman said back in the 70s.
Now, the first step toward understanding the cause of inflation is to recognize that it is always and everywhere a monetary phenomenon. It's always and everywhere a result of too much money. Inflation in the United States is made in Washington and nowhere else.
Money printing creates the situation where too much money is chasing too few goods, creating inflation. It's as simple as that. Everything else is window dressing. It's all contributing factors. They make things worse, they make things slightly better, but the root cause of inflation, the root cause that unless you treat that root cause, inflation is not going to go away, is money printing. And all of these elements he specified in this clip is all part of what you call the money printer. It's not an actual printer where you press a button. All of these elements he's specifying are increasing the money printing in the United States right now. And he's literally saying, look, guys, we cannot bring down inflation until we reverse all of these things we're doing right now that are contributing to increasing inflation. We can't just keep lying to ourselves that there's some OPEC thing or some corporate greed or some other nonsense like this. We have to slow down the money printing.
Of course. No government any more than any one of us likes to take responsibility for bad things. We're all of us human. If something bad happens, it wasn't our fault. And the government is the same way. So it doesn't accept responsibility for inflation. If you listen to people in Washington talk, they will tell you that inflation is produced by greedy businessmen, or it's produced by grasping unions, or it's produced by spendthrift consumers, or maybe it's those terrible Arab sheiks who are producing it. But none of them produce inflation, for the very simple reason that neither the businessman, nor the trade union, nor the housewife has a printing press in their basement on which they can turn out those green pieces of paper we call money. Only Washington has that printing press, and therefore only Washington can produce inflation.
And as you know, on this channel, I bring you people who have arguments. I don't bring you the get off my lawn grandpas who just argue and complain about things. We had Jamie Dimon putting out some really interesting arguments. We had Tom Lee putting some really interesting counter arguments. And right now I'm bringing you Larry Summers, a guy we haven't really talked about here on the channel because he's not really out in the public that much. But now he comes out with some major arguments. And the first one I want you to listen to is supercore.
The concept of supercore inflation.
If you recall in my video yesterday, we talked about supercore, excluding food, excluding energy, excluding shelter. If you take out all of these volatile cyclical elements, you get a true reading on inflation. And what we saw yesterday was alarming. And now Larry Summers is giving the same argument. I want you to listen exactly to what he says. Check it out.
That is taking out the transitory stuff and also taking out housing. And by that measure, inflation is running at above a 6% rate, and the 3-month rate exceeds the 6-month rate, and the 6-month rate exceeds the 1 year.
So what Larry Summers just said here is that supercore, the so-called supercore, is the purest form of inflation measurement. If you take out food, if you take out gas, if you take out energy, if you take out shelter, if you take all of this out, you lose a lot of the volatility, a lot of the cyclicality, and then you get to see exactly the real face, no makeup, the morning face of inflation. And right now, he's absolutely right. It's up 4.8%, but that's not even the real problem because he's actually hitting the nail on the head. The annualized 3-month run rate we have right now is 8%. And the really important point here is that he's saying, look, yes, it's 4.8%. It's very high. Annualized 8% is extremely high, but the speed is increasing. If you go back and you actually measure 3 months, 6 months, 9 months, year, the speed is picking up every single quarter you measure this. So basically what he's saying is that supercore is basically a runaway train, and if we don't catch it on time, it's going to pick up speed to where we won't have the ability to catch it. Now, he's saying that because of that specific observation, he thinks that the right thing, as we see right now, is to increase rates this year.
You have to take seriously the possibility that the next rate move will be upwards rather than downwards. And anything could happen. Markets could crash, the indicators could turn down. But on current facts, a rate cut in June, it seems to me, would be a dangerous and egregious error.
He's saying that obviously anything can happen, and nobody knows how economic conditions turn out. Maybe unemployment goes through the roof. Maybe massive geopolitical things happen. A lot can change that can send the economy into a slowdown that's not going to require a rate increase for the rest of 2024. He's specifically talking about the next 2 months. What needs to happen until June? And he's saying, look, from this point on until June, based on the current data we have, we should not cut rates. No, if anything, we should increase rates because we need to slow down the money printer. The supercore is running away. And this next clip is super important, but I don't want you to misunderstand it. He talks about the arguments of why rate increases are required right now, and he puts forth 3 very strong arguments. But I don't want you to confuse his actual macroeconomic view with the way economy feels like to everyday people. Because it sucks to be in this economy right now. Everything is hell expensive. Your dollar doesn't stretch as much as it did a few years ago. It's annoying, it's frustrating, it's a tough thing. It's a tough way to get by right now in this economy. There's no doubt. Now, when Larry Summers says that the economy is doing good, he's looking at it from an economic perspective. He's not looking at it from an everyday consumer. He's wealthy, he's well off. He doesn't feel that thing that we feel every day at the gas station, at the store, the grocery stores. He's talking about macro.
Look, why are we thinking about rate cuts when the economy is below what the Fed thinks is the normal unemployment rate, when the economy is growing faster than what the Fed thinks is potential, and when inflation is unambiguously above target and plausibly accelerating?
He's talking about the GDP, the gross domestic product, growing way faster than anybody anticipated. He's talking about low unemployment numbers on the macro level and the fact that inflation is still way higher than the 2% target. He's basically saying, why on earth would you cut rates in this circumstance? Unless, of course, it is a political thing you're going to do here, and the Fed is not political, right? Now, watch this next clip.
The Fed has once again, in important respects, lost its way over the last 6 or 9 months in the same way, making policy and making forecasts based on hope rather than on a hard-headed look at reality. I think that the Fed did a good job of cleaning up on the errors they had made in 2021. And I think it's reasonable to think that they will pivot off the errors they made last fall that led markets to be ludicrously expecting 6 cuts this year. And I'm hopeful that that will happen. But I think the Fed does need to learn some important lessons.
Now, in this next clip, he gives the Fed a huge compliment, basically saying, look, guys, you screwed up in the beginning, you fixed it, but now I fear you're about to screw up again. If you pivot, if you reduce rates in this situation, you have not learned a thing from your first screw up.
Price stability. And I'm afraid there are some signs that in the last few months, they have lost their focus in favor of more ambitious economic theories.
And when he talks about price stability in the second half of this clip, he basically says, look, guys, we haven't achieved it yet. And everyday Americans would agree with him. We haven't. Prices are still too high. Life is way too hard. Everything jumped up in price. Wages did not go up nearly as much as inflation did. So life right now in 2024 is a hell of a lot tougher than it was in 2021 or 2020 before this whole thing started. So right now, letting loose like this is going to lead to more problems, more cost of goods going up, and more inflation, which is going to screw the lower income people again. Because at the end of the day, inflation is a form of tax. The only problem is, instead of taxing the rich more, inflation taxes the poor way more than the rich. It's not me saying it, it's Milton Friedman saying it, and what Larry Summers says here goes along perfectly with what Milton Friedman said.
Have you ever known of a congressman who got up and said, I vote to impose a tax in the form of inflation of 10% next year? No, sirree. Inflation is a tax which is imposed without representation and which nobody has to vote for. And of course, it's a marvelous tax from the point of view of a congressman trying to meet the demands of his constituents for more spending.
What you know right now, if you had to make a decision, are we going to see any cuts this year? And what is the likelihood of actually an increase?
On current facts, I see no case for a cut in June, but facts can change. Inflation indicators could come in much lower than most of us are expecting. The economy could turn down. So never make an absolute judgment about policy several months from now, because all kinds of surprises could happen.
Now, I want you to pay attention to what he said here and what he didn't say. The question was about the potential of rate cuts for the rest of 2024. But he was very cautious. He said, look, we don't know what happens in December, in November, in October. It's too far. Right now, we can talk about from now until June for the next 2 months. And for the next 2 months, I don't see a possibility of a rate cut. And I agree with him. I don't think we're going to see a rate cut until June. But he basically says, look, we can't predict the future. Things can change. The economy can go south. A lot of things can absolutely change, and it will change our analysis. Based on current facts, from now until June, I don't see a rate cut. That's his position, and I completely agree with him. But he didn't say anything about September, about November, or about December, which is where I feel if we're going to have a cut, 1, 2, or 3, it's going to happen in these 3 months, or at least one of them. Now, this next discussion is beautiful, and I got to give credit where credit's due. I hate crediting mainstream media for great questions, but here, full credit, great question, and even better answer by Larry Summers. He was asked what causes inflation, and he gave you a beautiful 2-minute lecture about what causes inflation and how to fix it, not just by saying, hey, gonna reduce the interest rates. The entire monetary policy, the entire regulatory policy, the entire economic environment that's required to push inflation down to 2%.
The Fed has considerable influence over inflation expectations, which are an important determinant of subsequent inflation. I think monetary restraint does influence the economy, which feeds through into the inflation process. But gosh, we ought to be doing everything we can on the supply side. Anytime anybody sees a bottleneck, we ought to be going after it. I am all for effective competition policy that restrains price increases. I think the most important competition policy is maintaining economic openness and allowing competition for U.S. goods from less expensive foreign goods. That's the most important competition policy. That's the most important anti-gouging policy. That's the most important contain excessive profit margins policy. And so I'm sorry to see the extent of bipartisan consensus in favor of policies that are relatively protectionist.
And he basically specifies 5 things. May not agree with them all, but you have to listen. Number 1, the Fed has to communicate to the public that they're not going to cut rates in 2024. If the Fed does that, the expectation from the people is going to be for bad times, which means they're going to spend less, which means that it's going to be a self-fulfilling prophecy. Inflation will come down because people would basically be fearful and not spending as much. So you can do a lot with crowd psychology, and the Fed does not actually use it right now in the proper way, according to Larry Summers, because they're not telling the people, hey, stop spending because things are going to be bad for longer. So he basically saying the Fed needs to be way more of a bouncer. You know what a bouncer does in the club? He stands there, He looks, fearsome. Nobody wants to pick a fight with the bouncer. That's the whole job of the Fed here. They're not doing a good job of that. Number two, the supply side needs a lot of attention. Larry Summers basically saying, look, guys, we talk about interest rates, we talk about policies, but we have to make sure that the supply side is fulfilled, because if we have too little goods, it doesn't matter if we cut the money printer. If the money printer goes down, but the amount of goods goes down because of supply chain issues, we're going to be in the same hellhole. So we have to be mindful to keep the supply side coming up. The other thing he's talking about is the fact that we have to slow down the money printer, and that basically means higher interest rates. He talked about it the whole conversation, and that was another element. Now, the next two were really interesting, because then he says, look, we need to stop this onshoring business going on right now. Everybody's onshoring businesses because of what happened in COVID, and people are fearful that we'll not have the supply chains and whatnot. But if we overextend on the onshoring, if we bring everything back, the CHIPS Act, the Levi's jeans, everything comes back home, sure, we're going to have a supply chain, it's going to be clean. But if we go all out on this and not be proportionate, the cost of manufacturing, the cost of goods, the cost of production is going to drive inflation up. So even though ensuring certain items is important, strategic items like chips, right? Not everything needs to be onshore just for the sake of supply chains being open, because then you're going to be giving up cheaper manufacturing facilities around the world, bringing up inflation. Now, again, it's a very delicate matter. I'm just telling you what he said. Now, the next thing he says is that we have to allow more competition to develop inside the US. Now, that's a dangerous slippery slope, because if you over-empower the FTC, you've seen what happened recently. So it's a very, very delicate balance. Increasing competition without killing the golden egg laying goose, it's a very, very delicate thing. Now, I like the fact that he says that anything can happen, and his entire analysis right now is based on the current facts, and tomorrow we may have a new set of facts, and that might 180 the whole analysis. That's a smart thing to say. Now, where do I stand on this? I think he presents some valid arguments. The same way as Tom Lee presents some valid arguments, the same way Jamie Dimon presents some valid arguments. Now, at the end of my previous video, I gave you a few things that I'm doing to prepare for the option that he's right and Jamie Dimon's right. I'm not shorting the market, obviously, but I am making a few moves to mitigate the risk. That's all depicted in this video you're seeing on the screen right now. Go watch that video, see exactly what I'm doing, how I'm handling this, but I'm going to give you a little clue. I'm not panicking and I'm not selling. So breathe, relax, go to the video right here. I'll see you there in just a second.